Don't lose money. Zero is your hero. In this episode, we are going to address the question, what is indexing as it relates to investing money? This is one of my favorite strategies that I've helped thousands of people achieve financial independence. So get ready. My name's Doug Andrew, and I've been a financial strategist for more than 45 years, but mainly helping people prepare for retirement, the golden years, and not outlive their money. And unfortunately, a lot of people who thought they had enough accumulated in their traditional IRAs and 401ks didn't see what I call the deduction-reduction coming when they retired, because they had all this money they had deferred paying tax on in a traditional IRA or 401k, thinking they were going to be in a lower tax bracket, and they retired and they weren't. They start pulling out the money, they have to pay tax at the same or higher rate as they've ever been in during their earning years. And inflation takes its toll, and pretty soon they realize they may outlive their money, and many did. And so my favorite strategy for safe money accumulation in an investment, I actually call it the laser fund, but in the laser fund, which allows you to accumulate your money tax-free, under Section 72E of the Internal Revenue Code, everything you earn is tax-free. But Section 7702 of the Internal Revenue Code teaches us how to access your money tax-free, and it's way better than a Roth, because you can do that with a Roth. But at the end of the day, when I finally pass away, anything that's left behind, because most people leave behind something that would have sustained them had they lived longer. If it's in an IRA or 401k, most CPAs will agree that's the worst place to leave your money. Mine, in my laser fund, it doubles, triples instantly and transfers tax-free to my heirs. Now, you can learn about that. But in my laser fund, the best strategy is indexing. Let me give you Indexing 101 so that you can understand this concept. I'm going to use the example of a $1 million nest egg. Now, it doesn't matter if you have 100,000 saved at retirement, 500,000, a million, 10 million. We help people that are billionaires with this. But $1 million is a nice round number, and it's a good number because I've always shown people every $1 million that you accumulate can generate 80 to 100,000 a year of tax-free income, which is far better than $1 million in an IRA or 401k, because that's not all your money. Most IRAs or 401ks in the market, they tell you to only pull out 4% or 40,000 a year, and you have to pay tax on that. There's usually another 10,000 in fees you have to deduct, because that's the asset management fee, 1% on $1 million. So people pulling out 40,000 are only netting 20,000 after taxes and fees. I would rather pull out 80,000 or 100,000 tax-free and not be subject to market volatility, and it takes indexing to do that. Now, when I say indexing, a lot of financial advisors think I'm talking about indexed funds. No, indexing is a strategy. So here we go. I'm going to share an example of $1 million and apply what indexing does. So I alluded to my favorite vehicle, which I call the laser fund, and this is a maximum funded indexed insurance contract that has allowed me to earn rates of return averaging 10.07% for the last 25 years. For the last 45 years, the average has been 8.2%. Why the difference? Because the last 25 years, indexing has been around. It started in 1997. So here's the deal. If I have $1 million of cash value in my indexed insurance contract, I earn the general account portfolio rate that the insurance company is earning that given year. In the 1980s, when this idea was first introduced by E.F. Hutton, they weren't an insurance company, they were a brokerage firm, but they realized it's the only vehicle that allows you to accumulate money tax-free, be able to access it tax-free. When you die, it blossoms in value and transfers tax-free. I explained that in my various books that I've written, and what you're really doing is you're using an insurance contract for a living benefit. You're taking the least amount of insurance the IRS will let you get away with. You're putting in the most money that the IRS allows as fast as they allow, and this thing turns into a cash cow. So let's say I have $1 million accumulated, which I do actually pretty quick in a properly structured laser fund. Here's the deal. Let's say I'm retired. If I feel bearish about America, that I think we're headed for a recession, and many times I've felt that way, I can just hunker down and settle for what is called the general account portfolio rate that the insurance company is paying. How do they afford to do that? Well, back in the 1980s, I earned between 11.75% to 15.5% because interest rates were high. CDs at banks were paying 10%. Bonds and mortgage rates and everything like that were high. Well, the last 20 years or so, interest rates have been low. Generally, the general account portfolio rate of most AAA rated legal reserve insurance companies has been between 4% and 6%. That is the interest that they're earning on the average on all their mortgages on skyscrapers and shopping malls. And the reason that they're so safe is they only loan 50% loan to value, not 80% loan to value. So if they ever have to foreclose on a skyscraper, they come out smelling like a rose. They make money. They put very little into stocks. They put it in AAA and AA bonds. Let's use the decade, the worst decade since the Great Depression, the decade from 2000 to 2010. I earned an average of 7.23%. If I would have fallen asleep in the year 2000, I would have woken up in 2010 and I would have doubled my money because 7.2%, $1 million would have doubled to $2 million. Now I actually tripled to $3 million because I rebalanced my portfolio. If I had my million, back then, the general account portfolio rate was 6%. They need about one of those percentage points for them, for their overhead. And the net rate to me was 5%. So 5% on $1 million would be $50,000. I can just take the $50,000. If I take it out, it's tax-free. I can leave it there and it compounds tax-free. So the next year I have $1,050,000. Okay, it's tax-free regardless of whether I take it out or I leave it there to compound. Now, in a year that I feel bullish about America. Now, when have I felt bullish about America? During an election year where an incumbent is running for their second term. That happened in 2011. Barack Obama was running for his second term, and I've learned that anytime an incumbent runs for office a second time, they'll make the economy look like it's vibrant, dynamic, and growing with all kinds of fiscal and monetary policy. And so I knew my chances were better that I would earn more than 5% that year. And I was right. So with the indexing strategy, the few companies that offer it, I tell them, I want you to pay me whatever the index of my choice earns at the end of the year. And I chose November 15th to November 15th of 2012. That was the election year. Okay. So during that time period, the insurance company contractually must pay me whatever that index does. What's an index? That would be like the S&P 500. You have the Dow Jones. Let's just use the S&P 500. They offer that. So the S&P, they measure it, was it up or down from November of 2011 to November 2012? It was up more than 16%, but they have to cap me at 16. So I earned 16% in 2012 instead of 5%. Now, some people say, well, how can they afford to do that? They cap me because they don't have my full million to work with. No, my $1 million has to stay safe, tucked in the insurance company, earning 5. What am I giving up? I'm giving up the for sure 5. See, 5% on $1 million is $50,000. So I relinquish the interest on my $1 million. You can do whatever you want with that 5% interest, that $50,000, to have the wherewithal to pay me whatever the S&P does. And so what do they do with this? It's a no-brainer. They buy upside options in the S&P. So if the S&P goes up 10, the 50,000 of options double to 100,000 and they pay me 100 grand. If they triple, the 50,000 triples to 150,000. They're big boys and girls. They understand how to do that. And so I earn 16%. Why do they cap me? Because they don't have my full million. My million is safe. So that if I guess wrong and the market crashes, I don't lose a dime of my million principal. I only gave up the 50,000. I earned zero, and sometimes zero has been my hero. So by doing indexing, I have earned average rates of return at least 2.5% higher than the general account portfolio rate of the insurance company. This is where I moved from an average of 8.2% up to 10.07. When the market goes up, I get to participate to a cap. When the market goes down, I don't lose. I may not make anything, but I don't lose. And by doing that, in the worst decade since the Great Depression, 2000 to 2010, there were 5 down years versus 5 up years. Most decades have 7 up years versus 3 down years. If zero was your hero 5 years, but you earned whatever the S&P did in the other 5 years, you would have only reached the cap twice, but your average would have been 7.23% tax-free. $1 million would have doubled to $2 million. Most Americans were only back up to 620,000 at the end of losing twice in that decade 40%. By rebalancing, I only earned zero 2 years, 2001, 2008. The other years, I just switched back and earned 5. So I earned 5% 3 years, 0 2 years, and I earned whatever the index did up to a cap of 16% the other 5 years. And I tripled my money. $1 million was worth $3 million. Most Americans didn't get back to a break even of $1 million until 2012. This is indexing. And by using this, this creates a tax-free accumulation vehicle that knocks the socks off of any IRA, 401k, or Roth. So the key to indexing is don't lose money. Zero is your hero. You can harness the value of indexing so when the market goes up, you can participate in the upside. But when the market goes down, and it always will, you don't lose. If you think it's too good to be true, you need to read this book, The Laser Fund. It's explained in detail in here, and you'll see all kinds of examples of actual historical data that shows how people have averaged between 7 to 10%, but some years, like 2017, our clients earned 16 and 25%. The next year, if the market would have crashed and gone negative 40, they would have not lost the 25% they locked in the year before, because every year with indexing, you lock in your gains from the previous year and they become newly protected principal. This is so dynamic. I want you to have a free copy of this book. 300 pages containing charts, graphs, explanations, and 62 actual client stories on this side. This is about 12 chapters that contain those stories. I'll buy the book. It's free. You pay $5.95 shipping and handling, and I'll fire one of these out to you, and you can be empowered and learn how indexing can protect you from market volatility. And if you use the Laser Fund, it's tax-free, and inflation will help you instead of hinder you. So go to laserfund.com, Laser fund.com, and let me send one of these out as a gift to you.